Hello and welcome to this podcast from the Private Wealth team at Saffery's. My name is Leonora Stevens and I'm a partner in the Private Wealth team based in Bristol. I'm delighted to be joined virtually by Mike Hodges, a fellow Private Wealth partner at Saffery's, who's based in our Manchester office. Hello, Mike.
Hi, Leo.
Today we are very lucky to be joined by two external speakers from the private client world. Claire Harris, who's a partner in the private client team at the law firm with us, and James Peterson, who is a managing director at Rothschild. I am very lucky to work closely with both Claire and James on a number of clients. So welcome to you both.
Hi, Leo.
So today we are talking about how we advise clients who have recently acquired wealth. As accountants and tax advisors, we can consider this topic from our point of view, but feel it's really important to see the viewpoint from other advisors, hence why we've got Claire and James here today. We also feel it's a really valuable tool for our clients in being able to offer a slightly different perspective on matters. We could cover this topic in a huge amount of detail and probably speak for hours, but we will try to keep it short and sweet and as useful as possible. We'll consider the practical points for clients acquiring wealth from both the practical, legal, tax and investment side of the table, specifically covering what our first recommendations would be, how to pick advisors, and how important a client's objectives are, which I think is a common theme through all of our podcasts, is about what our clients' objectives are. So looking at the title of the podcast, Advising Clients Who Have Recently Acquired Wealth, there are various situations where clients may acquire wealth. This could be from inheriting a large sum from a relative, whether it's expected or unexpected. They could have sold their business and realised a large amount of cash, or they could have been lucky enough to win the lottery or received a large amount of money following a divorce. So my first question to my guests would be, if you're meeting a client who's about to acquire wealth or has just acquired it, what would be your first recommendation to them be? So James.
Hi, thanks, Leo. I think we always say let the dust settle and don't rush things. It's important to take a sort of clear-headed view of what you want to achieve with that wealth, and rushing into it is something that we see people do and usually regret later. So don't rush, take your time and let the dust settle.
And how would you recommend they choose their advisors or their team of advisors?
Yeah, choosing advisors is actually more difficult than it might seem. I think we're lucky that we operate in a world where there are lots of good advisors who have strong technical expertise, who are able to hold the hand of their clients effectively. When it comes to long-term wealth planning, I think beyond the technical expertise of the advisors that you work with, you also want to think about the chemistry. How easy do you find it to talk to them? It's very important that if you have long-term objectives for you, your wealth, your family's wealth, that you're able to discuss the trickier topics. So having lawyers and accountants with whom you can have a frank, candid discussion is really important. Thinking about the culture of the firms that they work with or work for, so that you're aligned well with those advisors. Again, that's really important. You're looking, if things go well, for advice over 10, 20, 30, even 40 years. And therefore you want to make sure that you're aligning yourself with the right partner over that long-term time frame. So clearly the expertise, but also the chemistry and the culture of the firm. Also thinking, do they have younger members of the business who might be able to perhaps work with the next generation of your own family? That can often help with succession planning and help with that kind of transition of wealth through time.
Nice. And Claire, what would be your first advice to people who are acquiring wealth?
I'd certainly agree with everything that James has said, but from a legal perspective in particular, we quite often start with will planning. And that's because it's a really good way of kind of getting to know people, and also for people to get to know themselves in the sense of thinking about what assets they have, what wealth they have, but also kind of thinking about their own views as to that wealth and how to benefit their children, and kind of understanding what their own objectives are in the way that they view that wealth. Slightly further down the line, you would be thinking about sort of pension planning, LPAs, maybe talking about the importance of prenups for people who have sort of relatively recently come into wealth. And then further down the line, maybe thinking about structuring and how to hold that wealth, and thinking about how to pass that wealth down to the next generation in a sensible way. And quite often there's this period of time, if someone has quite recently acquired the wealth, where they do need to kind of get up to speed with the way that they view it. And part of our role in that is being a sort of a sounding board as people who regularly speak to other people in their situations. And I quite often get asked, well, what do other people do in this situation? And they sort of learn almost from the experiences of our other clients by using us as brainstorming in terms of what they should be thinking about the wealth that they've acquired.
I always want to say, Leo, that it's a team game. And a lot of my clients have made their money in business in one shape or another. And they've had, if it's a widget manufacturer, that old cliche, they've had a manufacturing team, they've had a management team. Suddenly they've swapped all of that for cash. They need a new team. It won't be the same team, but they need a team on their side to help them navigate their way through.
Yeah, exactly. And also, as James says, you want to let the dust settle. I think isn't the recommendation for lottery winners is to wait for a year before they actually do anything, so they get comfortable with having that size of wealth sort of in their own name. And,
Yes.
it's the thought processes which take the time as to, do they want their children to have that money in due course? Do they want to make gifts, but actually, do they need some assistance about cash flow modeling to work out actually, well, if I spend this amount every year, then I can, for the rest of my days, I can give away another amount, and sort of get that IHT clock going, sort of the 7 years. But again, potentially, if they've had a widget business and all their wealth is tied up in a company where they would have got business property relief, and obviously following the budget, that would slightly change. When they hold the shares, historically, they would have got 100% BPR relief, no inheritance tax. Then they sell the business and they've got a huge pot of cash, which is then subject to IHT. So that sort of changes the game for them as well, is because they have to factor that in. And that's also where will planning with a good lawyer, such as that, would be able to assist with. One other thing to think about is, life insurance. And I think especially post-budget, this will be key for lifetime gifts, but equally looking at death. This are all things to throw into the mix for people when they've got this large amount of cash deposited. James, what about you in thinking about other objectives for these clients?
Well, it's about, I think, balancing objectives and not overemphasizing or over-focusing on one particular issue. Clearly, people want to be tax efficient, but we do talk about not letting the tax tail wag the dog. Don't let tax dominate the sort of planning decisions that you make. You want tax efficiency, but you want it within the context of the other things that you want to achieve. You want to think about how much liquidity and flexibility you want to retain. Perhaps think about some of the softer sides of succession, transitioning wealth to the next generation. So you want to include those in your objectives. You want to think about appropriate timeframes over which to achieve some of your objectives. Again, people often set objectives with a sort of open-ended timeframe, and so they're not really then able to measure successfully how they're progressing against those objectives. So again, thinking about beyond tax, think about things like succession, think about liquidity, think about flexibility, think about the timeframes within which you want to judge the effectiveness of your objectives.
And Claire, have you got anything to add on that about sort of relating to people's acquisition of wealth?
I think it's an interesting point you mentioned, Leo, in terms of it's sometimes there are things that can be done before the point of acquisition of the wealth. And you mentioned where you've got value in a business, there's potentially things that can be done from a tax perspective. Quite often, when I'm talking to a client, it's kind of a pre-inheritance scenario, and a lot of the wealth is still at the level of their parents. So actually, my client is effectively the middle generation. And they're saying, well, it's all very well me doing this planning and sorting out my estate, but actually, at some point in the future, I'm going to inherit this very large amount of money from my parents. Can I do some sort of pre-planning for that? And there is a certain amount of pre-planning that you can do from the parent's perspective, of course. And so quite often then I get introduced to the client's parents and talk to them about, well, your child is telling me that they don't want this inheritance. So actually, let's plan around that. Let's say, do we use a trust, or do we just skip the middle generation and go directly to grandchildren from the perspective of my client's parents? And there's benefits in getting involved before the acquisition event. And likewise, actually, if you don't have the opportunity of doing that whilst the parents are still alive, it's possible under UK law to vary the estate of a parent so that if you are in that situation where the parents leave their estates to that middle generation, but the middle generation doesn't need it, they can effectively vary the will of their parent so that it skips them and moves down to the next generation, or it goes on to a trust for the benefit of the next generation. So there is flexibility if that process isn't followed, but it's obviously it's better for that to be a kind of joined up process with the family more generally.
I suppose that, again, our regular listeners will know. Mike and I often talk about communication being key. So in your situation, communication early, discuss what people and objectives, what are they trying to achieve? If they don't want the money, then how to plan around passing on to the next generation in a controlled, if that's what they want it to be, sort of manner. And I suppose that also, you talking about you being introduced to the grandparents or the parents, advisors, when we're looking at advisors for clients and the spanning the different generations, sometimes, as James said at the beginning, you want to look at that succession point, but equally the advisors, the people who we're advising, their children might not want us. So it's sort of trying to factor that into the whole setup and a round table of advisors. Mike, have you got anything else to add on that?
No, I think that there is, don't be intimidated by it and don't go with the first person you meet. Just take your time. Yes, you want to get some building blocks in place, but don't rush, which is emphasizing again what James and Claire have said, that it isn't a race. It's better to take a bit of time to reflect. And your point, Leo, that in the case of a lottery winner, that the sort of general advice is wait 12 months. That has to be right, because it's suddenly a whole new world, and there's quite a lot of responsibility comes with this sudden arrival of wealth. And I think people generally take it seriously. They want to get it right. And therefore just press pause a bit and enjoy it as well. If you've worked really hard in your business, all the money's landed through a lottery win, just enjoy it. So don't get, because the advisors, we're quite serious on this conversation, aren't we? Let's not take all the fun out of it. So put some aside just to go and say, right, we're going to blow it on, whatever your thing might be.
Like you say, we're serious. I'm sitting here in my Christmas jumper, so we're not quite so serious. But yes. Well, so moving on with sort of from how to pick your advisors and what the first things we would consider are there any other considerations you'd want to talk through initially, Claire?
I think a lot of what I do sort of draws on the point that Mike was just making there as well, is kind of talking about wealth and what does this mean to the family and the impact that it will have on the family more generally, because quite often you're talking to people who, through whichever means, they will have acquired wealth which is more than they arguably could or reasonably could spend during their lifetime. And so they do have this responsibility as to what to do with it in the future, and principally on their death. And then there's this kind of education piece, both for that generation and for the next generation. So it's the acquirer's generation thinking about, well, what does this mean to me? Is this for spending money? Is this a rainy day fund for me? Is it actually a long-term pot for the next generation and generations after that? There are some psychological, philosophical points to think about from that perspective. And I often speak to clients who are quite nervous about sharing that information with their children. And it's understandable. There are people who quite rightly think that, children shouldn't receive too much too young, and that partially is also information about wealth too young, because that may impact the decisions that they make during their lifetime and may deter their ambition if they know that they're going to inherit a large sum at some point in the future. But equally, I think that you can go too far in the opposite direction as well. And I see people who don't have those conversations with the children whilst they're still alive, and maybe there's an untimely death and the children are in a situation where they've lost a parent and they're suddenly having to get to grips with this vast, sometimes, amount of wealth that they just hadn't been aware of, and they hadn't had that education process in terms of what that wealth means and the responsibilities and the difficulties, the challenges that actually come from being owners of that level of wealth. So it's a delicate path to tread, and it's one that, again, I think people do look to their team of advisors to help handhold them through the process, because it's the first time, only time, that they will be doing it in their lives. But we see that process ourselves with other families and kind of see these stories of what works and what doesn't work.
Well, I think a lot of people, the key for them is that they don't want their children to lack motivation or to sort of give up the incentive to get that job satisfaction or satisfaction from achieving something. And that sort of also stems from the succession point, where we spend a lot of time talking to clients about that. Do they make outright gifts of cash? Do they set up a trust? What age do the kids access the funds? What happens on divorce? And so, James, what do you see in your world with respect to sort of responsibility and learning points?
I think there's a lot to think about when suddenly you find yourself as the keeper of significant amounts of wealth. One of the things that we haven't really touched on, well, we've alluded to, perhaps in your reference to the lottery winner, but is thinking about the privacy and confidentiality that you want to maintain around the nature of your wealth. There are various different considerations there. And again, I think a team of advisors, and this is a point that Mike and Claire have both touched on, a team of advisors is really helpful. So empowering those advisors to think collectively about the various different things that need to be considered, ensuring that they're working together in your best interests rather than just thinking individually about their own specific responsibilities is really important. Privacy and confidentiality is one thing that I think is often overlooked in the sort of desire to structure things, to think about tax efficiency. Actually, some kind of occasionally sort of what I would call audit or review of your social media footprint, those kind of things can also be integral to ensuring that you keep the information that you've got private. Once the genie's out of the bottle, it's very hard to get it back in, because a digital footprint online is hard to remove.
Yeah.
Good point. And I suppose there's also, I know this is something that we discuss for clients, is the philanthropic goals of certain individuals. Is this something that you see more and more often, or?
Yep, absolutely. And it has a number of different sort of elements to it. I mean, there's a tax element to philanthropic giving, and that is something that people think of both during their lifetime and on their death. But I think there is also a very strong moral feeling that people have that if they have acquired a certain level of wealth, that it's important to give some of that back. I think as we see sort of wealth transitioning down to the next generation, lower generations, that seems to be, from my experience, something that people are becoming more interested in terms of giving. And it's also actually quite a good way of getting the next generation involved in the family's wealth. So, for example, parents are getting their 8, 9, 10-year-olds to think about what they can be doing within their world or within their school, the objectives that they have in terms of how you can give back through charitable donations and charitable activities. What we talk about is often, how do you do that? And obviously you can make direct donations to specific charities. And some of our clients will want to do a sufficient amount of charitable giving to set up their own private foundation, which comes with obviously the benefits of being able to direct exactly what you want to do with the money and have kind of full ownership over it, but with a certain amount of administrative burden because it is your own entity. And so a sort of halfway house that I think people are using quite a lot more is the donor advised fund, which is effectively that kind of middle ground where you have a third party who runs the administrative side of running a charity, but you can have a fund that is looked after by them from a charitable perspective, and you can direct how the funds are used from within your DAF so that you get the best of both worlds. And it's kind of horses for courses. So clients decide on which one they would prefer to use depending on the circumstances.
It does have, making charitable donations has a great tax benefit. We've got clients who make regular gifts, but they've got their own family investment company, and each year sort of they look at the optimal level of donation based on how much dividend they've had out of the company, or vice versa. And it's just a really useful tool where they've got their investments working well for them, and then they can equally make an impact by paying into their own charity or into a DAF. Although I think DAFs are getting ever ever more popular. From a sort of moving on from looking at wealth from an inheritance tax perspective, Claire, I suppose we've covered off briefly about what people can do if they don't want the money. But I suppose other than deeds of variation, are there sort of any other things you'd be advising?
I mean, I think it's all about the kind of the big picture family planning and making sure that all the members of the family are working together. We often see people structuring using, for example, family investment companies, family partnerships now, where you do a sort of pre-inheritance in the sense of making a gift during a person's lifetime, but maintaining some level of control over those assets that are passed down to the next generation, so that it's a way of planning for inheritance tax purposes, because you're not going to have that inheritance tax charge on death, but whilst keeping some level of control and direction at parent level for the benefit of children.
I was going to say, it's a bit of a challenge. What often happens when people find themselves reviewing the inheritance tax planning around a pool of assets is they're doing it perhaps 10, 20, 30 years ahead of when those assets might be passed on. The big challenge, of course, particularly if your wealth manager is doing a good job, is the pool of assets continues to grow. So you look at it snapshot in time today and think about the inheritance tax implications on that pool of assets. It's quite probable or possible that that pool could have doubled or trebled by the time that you pass on, and the issue could have become bigger. So what Claire is talking about there, the idea of actually facilitating planning that allows those assets to continue to grow, but outside your estate, is something that we're seeing increasingly, whether that be through the use of investment companies, through the use of trusts, other structures such as offshore bonds, for example. I think that kind of idea of freezing your assets and allowing the growth to accumulate beyond your estate is going to become more and more powerful.
Agreed. And I think that's to the benefit of that, as we're putting the marker in the sand. You're saying, right, I know what my liability will be if I die tomorrow. And as you say, any further growth, which hopefully there would be growth, can then pass on to the next gen.
Yeah. Especially if you're using life insurance is a brilliantly effective tool. It's effective because it's unlikely that we're going to see legislation against the use of life insurance, because obviously the government collects their inheritance tax. It's the life insurer that effectively pays it. But it is at a snapshot in time, and it's against today's value, not against tomorrow's or the future value.
Mike, have you got anything more to add?
No, I was just going to change the direction a bit. And I think in my practice in the last 6 months or so, the most common question I've been dealing with is where people can go in the world. And that's for a whole mixed bunch of reasons. So I know we're going off topic here a bit, but again, all your plans need to have some flexibility in it. So
is this a sideline in becoming a travel agent, Mike, where you're advising people where they go on holiday, or something a little bit more permanent than that?
I think I would always recommend a location that I need to go and vet first in person, and then for future client meetings, it's somewhere I fancy traveling to. No, there are all sorts of different family dynamics, and way beyond the time we've got to explore it today. But that has been the theme for me for the last, as I say, 6 months. Where in the world can people go and live? And that's not just a tax question; that's such a wider question. So that's my kind of parting shot, Leo.
That would definitely be one. I think that the move abroad is a very big move. Yeah, we've seen people plunge in at the deep end, moving to Switzerland or to Monaco or to other jurisdictions without testing it out first and finding actually it's not to their liking. So if you are going to move, I think the road test, going out there ahead of time, renting an apartment, getting a feel for schools, getting a feel for the kind of other aspects of real life, I think is really important.
Maybe just to add on the global mobility of families these days, and kind of you often get families with a mixture of nationalities, and that has an impact from a tax perspective as well. We see quite a lot of US people within a family network, which particularly because of the way that the US taxes, has an impact even if they don't move abroad. So is definitely, this global mobility piece is definitely something that we see in terms of our client base, and there is certainly planning that can be done in terms of people moving, but also the people who stay and have their home jurisdiction continue to tax them.
Well, I suppose that for me, the key takeaways for today on our sort of what to advise clients on who've recently acquired wealth is to let the dust settle and pick your advisors, but don't rush on picking those advisors, because hopefully they'll be with you for the long term, and pick your range of advisors. So you're not just leaning on one, you're leaning on sort of a collective thought of different professionals. So I would like to thank our guests, Claire and James and Mike, for joining us today. Just been a very interesting discussion. We work with a wide range of clients. Many are UK based and live overseas, but have interests here, whether that's property, business interests, or investments. We advise individuals and families on how best to safeguard, maintain, and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax rules in the UK, which can be complex. If you'd like to find out more about the services we can offer at Safri, please visit our website at www.safri.com. However, it's important for me to stress that if you're considering any of the topics discussed today, you must always take professional advice based on your individual circumstances. Thank you for listening.